First of all, true investors should be able to hold their money for 3 to 5 years at least. Anything shorter than that is very difficult to predict. And for shorter periods, relative economic growth, relative economic statistics are far more important. For true investors, the key factors to look at are quality, first of all, and then the value-price equation. And when you look at quality, let's take an example. Recently, Nestle put out their annual report. And if you look at their results, you see that they had a 35% return on invested capital. That means that for this 150-year-old company, their capital will double in about 2 years. So it's crucial to see whether that return is increasing. And you look at Nestle and you see that it is. Then you look a bit further, and this is where economic growth is important. You see that their business in Brazil grew by 10.7% last year in revenue terms to about $6 billion. You see that their business in China also grew by 10.7% last year. And you think, okay, well, there is growth there, and then you've got something that you can measure against the value that you ascribe to the stock, and you look at then at the price of the company. So in our view, it's key to look at the quality of the underlying company, the quality of the underlying business, the quality of the underlying earnings, and then look at price and value. But looking simply at economic growth, we think is a mistake. If you invested at the height of the internet boom a decade or more ago, where more than $1 trillion was invested, you would have lost a fortune. And guess what? There are only 2 companies that earn more than $1 billion. Out of all of the internet companies that have been invented, only 2 of them earn more than $1 billion. Similarly, you'd say that there's really high growth at the moment in China. I'm going to invest in the steel industry or the cement industry. Despite there being hundreds of companies in those 2 industries, in aggregate, they don't make any money. So you're much better off looking at companies that make a lot of money, that have very strong cash flows and can reinvest. Yeah, sovereign debt is a major issue. We believe that primarily investors shouldn't focus on short-term economic events unless they are very significant. So in this crisis, we were very focused on the emerging financial issues, and we tried to protect ourselves in relation to the crisis. Hence, the Magellan Global Fund was 30 percentage points above the various indices in terms of performance because of some protections we took in relation to the macroeconomic events. Ordinarily, however, it's important for investors to try as best they can to ignore short-term events and move on with investing in quality companies at attractive prices. The sovereign debt crisis fits in an in-between category. It's going to be crucially important. We think that it'll have impacts in a number of ways. First of all, it's likely that real long-term and short-term interest rates will rise. So investors should be cautious and protect themselves from that. And that's a supply-demand issue at the very least because of the sovereign borrowings. Secondly, you should be very wary about areas of the world having excessive concentration where there's very large leverage. And that includes sovereign, but it also, people need to factor in relation to Australia that we've got $650 billion of net foreign debt. So it's not just these sovereigns that are of issue. Thirdly, the repayment of the sovereign debt around the world will require higher taxes and will result in a lower growth rate over time. So you must factor in conservative assumptions in terms of future growth rates. And that's primarily the developed world, but it also impacts upon the emerging markets as well. Yeah, first of all, emerging markets are not just an homogenous unit. If you look within the emerging markets, and I've spent quite a lot of time in China in the last few months trying to, as properly as I can, understand what's going on. You need to look at individual companies. So if there are 300 cement producers, if there are 300 auto manufacturers, you know that they're not all going to make it. You know that they're not all going to get very high returns on capital. I mentioned Nestle earlier. Nestle gets 35% return on its invested capital, and that's been increasing over time. There are very, very, very few companies in emerging markets that get such high returns on capital. Secondly, if you get through the quality filter, you then need to look at the price. Many of the best Chinese companies, and there are quality Chinese companies, are trading at 60 times current cash flow, 60 times current earnings. You can buy companies of the calibre of the Coca-Cola company at 14 and 15 times. McDonald's has earnings of over $500 million in Russia. It's by far the largest QSR company in the world. Yum Brands similarly, it earned last year $602 million US in China, so it has a huge emerging markets exposure. They earn more in China than all of the Chinese QSR companies put together. Yum Brands is a much better way to invest in China than the other QSR companies. We want to blend in to Australian portfolios. So we understand and are supportive of the long-term growth prospects of the emerging markets. And therefore Australia is already a major beneficiary. But what we want are the people like Coca-Cola and Yum and McDonald's and Nestle that will be selling year in, year out. We'll be talking hopefully in 50 years' time, and they will be the dominant consumer companies within China, for example, Brazil, India, Russia, not just having sold the iron ore and the steel in 1 year. In relation to resource companies, it's very difficult to predict what prices will be going into the future. At the moment, BHP has a marginal cost of production for coal and iron ore of, let's say, $20 US per tonne. They sell at 120 or more per tonne. In history, those prices have converged. If they converge, people who are putting a 15 times multiple on current earnings are going to get hurt. We don't know what will happen, but the probabilities are such that we think that there's risks in doing that. Therefore, what we're trying to do is to apply a fantastic quality filter where we get great certainty of earnings going into the future. And guess what? Right at the moment, we find that we can buy them at attractive prices. And our extra bonus is that the Aussie dollar, of course, at the moment buys more pounds, euros, US dollars, other currencies than they've ever done in the past. So we're getting more bang for our buck by looking at these great international companies. So sure, keep the Aussie as part of your portfolio if you're comfortable with it. But what we like to do is to deal in as much certainty as we can get. So on a probability weighted basis, we're much more comfortable buying McDonald's on its current terms than we are in rushing into a number of the Aussie stocks.